Imagine a scenario where banks are raking in record profits while everyday consumers struggle under the weight of high borrowing costs and meager savings returns. This is the stark reality in Israel today, and it's about to reach a boiling point. After nearly 2 years of holding steady, the Bank of Israel is poised to cut its benchmark interest rate, a move that's as much a warning to greedy banks as it is an economic strategy. But here's where it gets controversial. While the central bank chief is expected to announce this cut on Monday, the question remains, will it be enough to curb the profiteering of Israel's major banks? And this is the part most people miss. Even if rates are lowered, will banks finally start playing fair with their customers? The backdrop to this decision is complex. Inflation in Israel is already within the government's target range of 1% to 3%, sitting comfortably at 2.5%. Forecasts for the final months of 2025 even suggest negative inflation rates. Meanwhile, the government is pushing to pass a state budget for next year, which could be approved by the Knesset in March. Adding to the pressure, the U.S. Federal Reserve has already lowered interest rates, and another cut is on the horizon. If Israel doesn't follow suit, the interest rate gap between the two countries could widen, potentially weakening the shekel further against the dollar and euro. On top of that, Israel's economy is in dire need of a boost following the recent war, and a rate cut could provide short-term growth. But not everyone is on board with this move. Political uncertainty looms large. If the ultra-Orthodox military conscription bill fails and the budget isn't passed by March, the Knesset could dissolve, leading to a transitional government through next fall. These concerns might justify keeping the current rate of 4.5%. Yet, the Tel Aviv Stock Exchange is already buzzing with speculation, and foreign exchange markets are bracing for the shekel's likely weakening when trading opens on Monday. The real controversy, however, lies in the bank's record profits. In the third quarter of 2025 alone, Israel's 5 largest banks reported a staggering NIS $8.7 billion, $2.61 billion, in profits, an annualized rate of NIS $35 billion. $10.5 billion. To put that in perspective, it's up from NIS $30 billion, $9 billion, in 2024. At first glance, this might seem like a success story, but the catch is that these profits are coming at the expense of consumers. Borrowers are paying more in loan interest, while savers are earning next to nothing on their deposits. For nearly 2 years, the Bank of Israel's benchmark rate has remained at 4.5%. With the prime rate at 6%. Yet, commercial banks have been quietly slashing the interest they pay to account holders, often to as low as 0.1%. Deposit interest rates have also been cut significantly, despite the central bank holding rates steady since January 1, 2024. This one-sided arrangement has fueled public outrage, with even the Knesset and Finance Ministry stepping in to demand change. The Bank of Israel, typically hands-off when it comes to bank policy, has expressed rare frustration, urging banks to introduce benefit plans for reservists and small businesses affected by the war. But here's the kicker, even if the central bank cuts rates, there's no guarantee banks will pass on the benefits to consumers. Lawmakers' patience is wearing thin, and if bank executives don't get the message, they could face far more intrusive regulation, or even legislation forcing them to narrow the interest rate gap. The Finance Ministry has already taken a stand, announcing a new tax on the 5 largest banks in the 2026 budget, expected to raise at least NIS $750 million, $225 million, annually. While this move has merit and could promote competition by exempting smaller banks, it's unlikely to significantly dent the massive profits big banks continue to enjoy. The real solution? Narrowing the gap between the high interest rates banks charge borrowers and the meager rates they offer depositors. Even a 0.25% rate cut on Monday won't solve the problem unless banks are compelled to play fair. And if they don't, the consequences could be far-reaching. So, here's the question for you. Is it time for more aggressive regulation, or should banks be given another chance to self-correct? Let's hear your thoughts in the comments. This is a debate that's far from over.